whenever you are finding difficult or you are not able to understand when you are reading the books, then in that case you can check it in Google. Okay, then you can understand that I can suggest. So morning I have seen, and these are the syllabus for agriculture economics. ARS or let it be ARS NET or for maybe mains, maybe for SRF. Basically, there are 6 units, and as he said rightly by Reddy, that one is economic theory, second unit is agriculture development and policy, third is natural resource and production economics, and fourth agriculture finance and project management. So I am going to discuss in agriculture finance and project management unit on the fourth. Not all the contents. So almost I'm going to discuss this unit, fourth unit. Then unit 5, agriculture marketing and price analysis, and unit 26, operation research and research methods. And on right hand side, so I have given some reference books. And if somebody is not knowing that what books to be studied, and you can see these are the books to be referred for ARS, NET or SR, for let it be anything. So I have written here modern microeconomics, and this is a very good book. Either you can read this one, Principle of Microeconomics or Modern Microeconomics. So the advantage, this book, Modern Microeconomics, that marketing, not marketing, that perfect, that marketing in this perfect market, that imperfect market. So there they have written on clearly instead of, Principle of Microeconomics. Then macroeconomics, we can refer, HL Aguja. I would suggest for economic development and policy, better to refer Todoro, Michael P. And this is a very good book and very famous. And instead of referring, Jingan. In Jingan, it will be like a story and so many things it is written. But in case of Todoro, it is a very brief and nicely it is written. And if you, I would suggest better to read Todoro. Then for agriculture finance and management, you have to refer Subba Reddy, P. Raghuram Ram. Then agriculture production and the economics. Then Sankyan. Then this you may not find, I think you will not find maybe in the market. If some friend, maybe if somebody is there in IRI, your friend, you can ask them to send these books, agriculture production economics, Sankyan. Otherwise, we can ask Dr. Chanjay, sir, and so he may be having. So that is very good. Agriculture production economics written by Sankyan. Then agriculture marketing in India, Acharya and Agarwal. This is a basic books, at UG level. Then agriculture price analysis also we have Acharya and Agarwal. Then economics of farm production management, VT Raju. Then basic economics is Gujarati. Then research methodology you can refer on the CR on the Kothari. And these are the books. So we have to refer. And need not to be read in case of microeconomics and macroeconomics Agija. And no need to read all the pages. Only the important topic or based on syllabus you can refer these books. And is there any doubt? Hello?
No.
Okay, if any doubt is there, then and there, please stop me and let me know the doubt, and you can clarify. Okay. So this is what I'm going to cover this topic of agriculture projects. So in agriculture project, I'm going to cover what is a meaning, a definition, then concepts, so including type of projects. It is there in syllabus, I have seen. Then different stages in project cycle, then project risk analysis, then investment appraisal techniques. I'm going to cover, benefit cost ratio, internal rate of return, net present value, then modified NPV and modified IRR and so on. Then analysis of financial statements, balance sheet, cash flow statement, then profit and loss statements. That is also there in syllabus. Then Kishan credit card schemes, e-banking, and finally financial inclusion. That is also there here on the syllabus. This is what I'm going to cover this entire topic, entire PPT. Now coming to agriculture project, and you should know what is a project. See, in a simple terms, project means so is an activity where money is spent in order to get returns. That is known as on the project. So I have written here so many definition of what is a project or what is agriculture project. So it is an investment activity in agriculture where financial resources are spent to create the capital assets with an anticipation of benefits over a period of time. And agriculture project, there is a starting point and as well as there is on the end point. Irrigation, dairy, poultry, fishery, rural credit, social forestry, land reclamation, and rural development projects are the best example of agriculture projects. So investment in agriculture, basically there are only two types. One is operating investment and the second one is a capital asset investment. Operating investment means that is investment made on operating, that is within a production on cycle. For example, like seed, feed and fertilizer are the best example. Second, investment made on capital assets entitles, it is a longer period of time. For example, like land, machines and on the projects. In profit maximization principle, this is what I am going to discuss in a subsequent slides. That is a time value of money. That is a discounting and a compounding is a very much important. Why we want to do discounting, why we want to do compounding. So here in profit maximization principle, and time is not brought into consideration because the expenses and the receipts are assumed to fall in the same category. Whereas the investment made on the capital on the projects have a different on the time periods with respect to cost and the returns. So therefore, in order to assess the returns from investment, so we have to use this time value of money. So time value of money is very important. So we'll talk in subsequent slides. Then coming to types of agriculture project, basically there are 4 types of agriculture projects. One is a water resource development project, second agriculture credit on the projects, and the third one agriculture development projects, and the fourth one agro industries commercial development on the projects. The first one, water resource development on the projects, irrigation projects, groundwater project for land reclamation, drainage project, salinity prevention, flood control are the example of water resource development on the projects. So the objective here, that bringing about overall agriculture development, that is providing drainage and reclaiming soil salinity are the objective of this project. And the second, agriculture credit on the project, this is also called on lending projects. So here credit is given to the farmers for farm investment. So with the purpose of increasing agriculture production, raising their standard of living, and economic as a whole are called on the agriculture on the credit on the projects. In case of agriculture credit on the project, that the end use of this credit on their investment, so need to be evaluated to assess the impact acquired to the beneficiaries. Then all the financial institutions, I think you might be knowing the financial institutions like regional rural banks, cooperative banks, commercial banks are the credit on the houses. So that should be taken on the care while implementing this on the credit on the projects. And the third one, agriculture development on the projects. So this project aimed at improving farm economic individual and regional development. For example, like a diversified cropping system approach as well as farming system approach can be used. Another example also I can quote protected cultivation. That is also agriculture development on the projects. Then finally, agro industries commercial development projects, and this includes input supply, service to farming, projects concerned with the processing, storage, market development, projects for fisheries development, projects for development cooperative farms are the example of agro industries commercial development on the projects. Now coming to project on the cycle, and you should know what is a project on the cycle. So project cycle is a natural sequence, so in which the project is planning and on the carrying out is known as on the project on the cycle. So there are 6 important stages in on the project on the cycle. One is identification. This is very important. One is identification. It is also known as conception of the project. Second, formulation, it is also known as preparation of the project. Third one, appraisal, it is also known as analysis of the project. And the fourth one is the implementation. And the fifth is a monitoring. And the sixth one is a evaluation of the project. And let us see one by one identification of the project. First one is identification. See, in agriculture project, cost can be easily identified than the benefits, because the expenses we can easily we can visualize, and there are on the different type of cost are associated during identification of the project, and these are the cost. One is a project on the cost. Project cost means this includes value of the resource in maintaining and operating the project is known as project on the cost. Second, associated cost, that is a cost incurred for producing immediate product and the services. And the third one, primary cost, it is also known as on the direct on the cost. Cost incurred for construction, maintenance and execution of the project is known as on the primary cost. And the fourth one, indirect cost, is also known as secondary cost. That is a cost incurred for value of goods and services, incurred for producing indirect benefits. Indirect benefits means, for example, like house, schools and hospitals. That real cost and nominal cost, this is very important. See, nominal cost means if cost at the current market price, so it is known as nominal on the cost. Real cost means if the costs are deflated by general price index, then it is known as on the real cost. Then social cost means this includes technological externalities and a technological spillover acquired to the society. For example, like pollution problem, health hazards, salinity condition are the example of social on the cost. So once a cost is identified, the next things you have to identify the benefits. So benefits can be identified, with the help of, with and without method. And the difference is a net incremental benefit, we can say. And benefits also divided into two types. One is a tangible benefits, another one is a intangible benefits. So tangible benefits means that is a incremental income due to existence project is obtained from the following changes. That is improvement in cropping pattern involving high value crops. Okay. Then increase in the productivity of crops, adoption of recommended package of practices, increase in the intensity of cropping, reduction in cost of cultivation, large scale economics due to specialization are the example of tangible benefits. Intangible benefits, these tangible benefits you can measure directly, but intangible benefits you cannot measure on the directly. So this can be measured, through better income distribution or better on the standard of the living. In identification stage, it is very important. It is very important to see whether the project is implemented in high priority areas, whether the project is implemented in identification stage, and it is very important to see the problems and objective of the project, whether government gives sanction for the project implementation or not, that we have to see. And in identification stage, there are only three types. One is a preliminary study, pre-feasibility study, and the third one is a project on the report. And this is about identification. Second is a preparation of the project or formulation of the project. And before formulating the project, and these are the following points you have to keep in consideration. One is a location of the project. Location of the project and project site must be based on technical analysis and on the technical feasibility. Under the location of the project, it depends upon the physical resource available, market condition, market facilities, then investment prospects, technical skill, innovation, demand for products, and so on. So that all you have to keep in mind while preparing the projects. So there are 6 important steps involved in preparation of project, and this is very important. And they may ask in net also. And one is a technical aspect. Second is institutional or managerial aspect. Third one is organization aspects. And fourth is a social and commercial aspects, and financial aspects, and finally economic aspects. Technical aspects means all the technological aspects must be thoroughly studied under the technical aspects. That is known as on the technical analysis or technical aspects. In, for example, in agriculture project, so the major issue or pre-production, which involved, during pre-production, then production, and on the post on the production. So with this, you have to examine that during pre-production. So what is a issue, and during production and post-production, what are the issues? So issue can be, like you have to examine the soil type. Okay, maybe problem associated with different types of soil, then irrigation supply and availability, then types of crops on the grown, then availability of decided variety, then other credit facilities, pest and disease problem, yield, storage, processing, marketing facilities. So all should be on the covered under on the technical aspects. Then the second is the institutional or managerial or administrative aspects. Under administrative aspects, one is a managerial aspect, then on the project on the top staff, then extension personals, technical skills, credit agencies, and beneficiaries will be studied. That is known as managerial aspects. Same thing I have written here. If you want successful implementation of the project, effective managerial issues are very crucial. So first you need to identify the beneficiary. Once identification is over, then you have to find out the managerial competence of the beneficiaries. Based on this, you can sharpen their own skills. If necessary, technical skills also provided by the extension agents. It is known as on the administrative aspects. And the third one is the organizational aspects. So organizational aspects, which covers, the relationship of organization, the relationship of administration and the government. Okay, then maybe the disbursement of wages and the demarcation of authorities, all comes under organization aspects. Then what is organization? So organization means it is a process of putting the priorities in an ordered form, and availability of staff for the various cadres, demarcation of authority, the linking of authority and responsibilities are comes under organizational aspects. Then commercial aspects. So commercial aspects, which includes, okay, that is the availability of input on the supplies, then arrangement for on the output of the marketing, arrangements for on the marketing. It is known as on the commercial aspects. Same thing I have written under commercial aspects. You have to estimate the demand. You have to estimate the effective demand. Then you have to see the availability of inputs. Then you have to see the possibilities of marketing of your own products. So comes under commercial aspects. The another one is the financial aspects. So financial aspects, which deals, source of funds, then cost of funds, then repayment schedule is known as, financial aspects. Financial aspect deals primarily with the source of raising financial assistance and terms and conditions of obtaining finance from the credit agencies. Then implementing agencies should be in a position to estimate the financial requirement and anticipate return through farm planning and budgeting. And you might have studied or you might have known. So what is the difference between farm planning and budgeting? See, farm planning means it is a decision-making process in farm business. That is known as farm planning. And the farm budgeting, that is a expression of farm plan in a monetary term through estimation of receipt, expenses, and the profit. It is known as the farm budgeting. So under farm budgeting, there are different types. You might have studied, partial budgeting, enterprise budgeting, then on the complete on the budgetings. And did you get my point? Hello?
Yes, sir. Yes, sir. Yes.
Do you have any doubt?
No,
farm
sir.
Planning and budgeting. If any doubt is
No,
there,
sir,
please
no
let me know. Okay.
Yes, sir. Yes, sure.
Then once the incremental income is arrived at repayment capacity, I told you that in financial aspects, source of funds, cost of funds, then repayment schedules will be scheduled under the financial aspects. Then another one is the social aspects. Social aspects, which includes, customs, culture, tradition, and habits of the beneficiaries are only considered. The other important on the changes, like changes in standard of living, maternal welfare, consumption habit, income distribution also studied under the social aspects. Then last one is economic aspects. See, in economic aspects, it is very important, here we have to examine the benefits and which contributes, significantly to the society. That is by utilizing, the scarce resources of the nations. So that is known as economic analysis. See, in economic analysis, we are determining whether the project is likely to contribute significantly to the development of the economy as a whole, and to it whom the project is going to benefit. Is it one section of the society or entire area of the project? Like indirect effect also we can estimate through economic aspects, that is income distribution need to be assessed. Then under income distribution, the purpose is to know whether income inequalities are going to be narrowed down or widening out as a result of proposed project. But overall, it is expected from the project to bring large contribution to the national economy. It is known as on the economic aspects. There is a difference between, economic and the financial analysis. And so economic analysis and the financial analysis are complementary. Okay, both economic and the financial analysis. And this is important. In economic analysis, we deals with only society. But in case of financial analysis, deals with the individual owners or the participants of the project. This is the main difference. Then in economic analysis, interest on capital is not deducted from the gross return analysis because it is part of the total return to the capital available to the society as a whole. But in case of financial analysis, that interest paid to the external supplier money is deducted. So here interest is not deducted, but here interest on capital is deducted under the financial analysis. In economic analysis, taxes and subsidies are treated on the transfer of the payments. I think you might have studied in macroeconomics. What is the taxes? What are the subsidies? What is the transfer payments? Okay. So I'm not going to discuss in details. Okay. So in a financial analysis, so such adjustments are not necessarily taken in case of financial analysis. So in economic analysis, tax and subsidies are adjusted to reflect more accurately the social and economic values. These adjusted price are called the shadow price or accounting prices. This is very important. And this type of question they may ask, in ERS net also, even ERS exam also. Even when I wrote, ERS net or ERS mains, so they asked me this 2 mark and as well as in 5 mark about, shadow prices. That is very important. Shadow prices, it is also known as accounting prices. Shadow price means it is an artificial, price assigned to the non-priced assets. It is known as on the shadow price and accounting prices. And this in a detail you can read in economic development books. I told you that Todoro, it is neatly and it is given elaborately, so you can refer. So you should understand what is a shadow price or it is accounting prices. Okay, so it is an artificial price or assigned to the product, because some products, if you take like forest products, okay, maybe if you want to estimate price for the forest, maybe that products may not be available in the market, may not be available in the open market. So in that case, you have to use this shadow prices. Okay. So in financial analysis, the tax are usually treated as a cost and the subsidies as a return. So in this analysis, market price are normally used, which takes into account taxes and the subsidies. So these are the main difference in economic and the financial analysis. Then another important stages in project cycle, that is appraisal. It is also known as analysis. Appraisal should take place before the implementation of the project. So it is important to know whether the project is technically feasible and according to the data available. And the technical data for assessing feasibility of the project and should be consistent with the information available in the office of the sanction authority. This all you can read in book. It is given in book. So for in case of agriculture finance and on the project management, I would suggest you should read Subba Reddy. There is separate book for agriculture finance and on the project management, and you have to read there everything. It is on the given. But here you should understand the meaning, and the rest you can read it by yourself. Okay. Then implementation. So implementation, this is most important part in a project life cycle. And two things, you have to keep in mind in during the implementation of the project. One should be, a better and easily carried out, so that, returns also are realized. That is one. Second, the project implementation must be flexible. These two things is very important, while implementing the project. So in the project implementation, there are only three types of periods. Okay. One is the investment period, and the second is a development period, and the third is a full production period. So investment period means it ranges from, few months to few years, and depending upon the nature of assets to be acquired. Second, development period, and compared to investment period, so it consumes, time, and the implementing agency should make all the efforts to reduce the gestation period as per the plan envisaged in the beginning. Then full production period is the time and during which the beneficiaries start reaping the benefits of the project. It is known as, full production of the period. And the methods of, project on the appraisals. I told you that appraisal, it is also known as on the analysis. Okay. And how to do the analysis, or how to do the appraisal part. And these are the methods we can estimate, or we can do the analysis. One is economic analysis, financial analysis, market analysis, technical analysis, managerial competence, and ecological analysis. In economic analysis, which includes, requirements for raw material, level of capacity utilization, anticipated sales, anticipated expenses, proposed profits, and estimated on the demand. Under financial aspects, which includes, cost of capital, means of finance, estimates of sales and production, cost of production, working capital, then break-even point. We will talk in subsequent slides what is a break-even point. Okay. Then projected cash flow also will talk, and projected balance sheet also will talk. Then third, market analysis. Under market analysis, there are only two types. One is a opinion pooling method. Another one is a life cycle segmentation analysis. Opinion polling method means, see, in this method, opinion is collected from the ultimate users. Here, when I say ultimate users, means here it is nothing but, consumers. So this can be done, either by, by taking, a complete survey, or by selecting a few sample of the consuming units of the relevant of the population. It is known as opinion pooling method. Okay. Then second is life cycle segmentation analysis. Life cycle segmentation analysis means, so in this, method, and we are, doing the research. We are doing the consumers research. So that can be done at different stages in the project on the cycle. And if you see the diagram on right hand side, that during the introduction stage, and you have to see that market potential assessment, then clients needs, then you have to see the price evaluation and the competition analysis. And during the growth stage, and you have to see the distribution analysis, promotion research, customer satisfaction, then use or attitudes of analysis. During maturity, you have to see the brand positioning, market segmentation, market potential, market monitoring. During declining stage, you have to search for new markets, analysis of merger, acquisition possibilities, and market monitoring. And the technical analysis, I told you that all technological, aspects need to be covered under the technical analysis. Like in terms of, resource endowments, I can say that under technical analysis, like, availability of land and site, then water, transport, communication, then availability of servicing facilities, then availability of workforce, then raw material, and everything you have to see under the technical aspects. Then under ecological analysis, you have to see the environmental damage and the restoration measures. Now coming to the monitoring. Monitoring is the last stage, not last one, and it is also in a fifth important stage in a project cycle. That is, it is a timely collection. So monitoring means it is a timely collection and analysis of data on the progress of project and with the objective of identifying constraints with which impaired successful implementation. And this is highly desirable, and particularly when the project fail to be completed as per the schedule or in the process of attaining the set goals. And it is imperative to get the feedback on the problem faced so that effective measures can be taken up to improve the deficiency which hamper the speedy implementation. And monitoring has to be done continuously to remove or offset various shortcomings that are faced from time to time at the time of implementation. Then evaluation. See, there is a difference between, first let me tell you the difference between what is the monitoring and evaluation. See, monitoring is a continuous assessment of the project. And evaluation means it is a periodic assessment of the project. This is a main difference. Monitoring means it is a continuous assessment. Evaluation means it is a periodic on the assessment. So monitoring, the question is the project doing things right? In evaluation, the question is the project doing the right things? And these are the other differences, monitoring and on the evaluation. Okay. Then you're coming to evaluation. See, evaluation is basically, done, not only, confined to the completed project. Don't think that it is after completion of the project we have to do the evaluation. It is not like that. So it is not confined to the completed on the project. So the evaluation can also be done. Evaluation can also be done and during the period of the project, during the life of the project. So it is during the evaluation process, it is very important. It is very important, or it is very imperative to see that how far the objectives has been reached. That is a evaluation. In evaluation, there are only three types. One is a mid-course evaluation, concurrent evaluation, and a exposed evaluation. In mid-course evaluation, that evaluation is done, before any changes occurs in the existing situation. And this can be done by using economic feasibility of the project. So it is also known as pre-project on the evaluation. Second, concurrent evaluation means done when the project is in execution or during the project. It can be done. That is a concurrent evaluation. So it is essential to know the weakness of ongoing project, and so that this may be corrected for on the greater on the success. It is known as on the concurrent evaluation. And the third one, exposed evaluation, is done when the project is completed. And however, the overall impact of the project can be assessed once it is over. So mid-course evaluation means that is before beginning of the project we have to do. Concurrent evaluation means that is in between. Exposed evaluation means once the project is completed, then we have to do, that is exposed evaluation. Okay. And these are the criteria for a selection of agriculture projects. One is a work selection on the criteria, that is based on, it should be, immediate needs of the project area. Based on immediate needs of project area, you have to select. Second, priority criteria. Project should be implemented, under priority area or not, we have to examine. Then social criteria, then you have to see the employment prospects, ecological balance, externalities, pollution, and so on. I told you that social cost we have to see. Then financial criteria, then you have to see that whether the required amount of capital is sufficient or not during the implementation of the project. Then you have to see the supply criteria regarding availability of resources, physical inputs, labor, and so on. Then implementation criteria, then you have to see the organization capability and managerial abilities. Then finally, project benefits, you have to see the tangible, intangible benefits. Then you have to see the forward linkage and backward linkage also to be given on the basic weightage. So what is a forward link? There is a difference between forward linkage and backward on the linkages. See, tangible benefits means we can say that the tangible benefits means, I told you that we can measure. We can directly measure. So tangible benefits means that is increase in output of crops or livestock. Okay, that is a tangible benefits. Okay. And due to increase in output, there is a changes in activity. Changes in activity, or let's say like marketing, okay, transportation, okay, there may be a processing, Okay, so which adds profit to the person. Okay, so that is known as forward on the linkages. And backward linkages means that is a extra profits occurred to the input suppliers, so it is known as on the backward on the linkages. Is there any doubt difference between forward linkage and backward linkage?
No, sir. No, sir. It is clear.
Now coming to a main topic, this is a topic it is given to me, that is discounting and compounding. Okay, we'll discuss in details here. And up to this, I think there won't be, if it is if doubt is there, please let me know at the end. Okay, or in between also you can ask. Now coming to this investment analysis. So investment analysis, it is also known as on the capital on the budgeting. I told you that time value of money. See, in a profit maximization principle, and time is not taken into consideration, because the receipts and expenses are assumed to fall in the same production on the cycle. But investment made on the capital assets, which have different time periods with respect to returns. So therefore, we need to assess, returns from investment. Okay, returns from investment, and we go for time value of money. In time value of money, there are only two types. One is a compounding, another one is a discounting. Compounding means the future value of present money is known as on the compounding. This is primarily due to the opportunity cost. When I say opportunity cost, it is nothing but interest. So interest is added to the principal amount, hence it is value is increasing. Okay, so that is known as on the compounding. So interest is added to the principal at the end of the each time period, which in turn it is known as on the compounding. Let me give one example so that you can easily understand what is the compounding. Suppose you have 1,000 rupees with you, okay, and you deposit that 1,000 rupees with the financial institution. Financial institution, it can be a commercial bank, it can be a regional rural, it can be a cooperative banks, for a period of 3 years, and the rate of interest is, let's say, 10%. Okay, then after 1 year you will be getting 1,100 rupees. So your deposited amount is 1,000. That additional 100 rupees is nothing but interest which you have earned for the year. In second year you will get 1,210. In third year you will get 1,331. This is nothing but on the compounding. Is there any doubt? Compounding, this is very important. Any doubt is there, please let me know. See, compounding means future value of present money. I have given example also. Okay, suppose we have 1,000 rupees. Okay, now you deposit that 1,000 rupees with the banks for the period of 3 years, and let suppose the rate of interest is 10 rupees. Now how much you are going to earn after 1 year or second year or third year, that is nothing but on the compounding. Okay, and this is a formula for on the calculating, that is A is equal to P 1 plus I power of on the T, where A is nothing but future value invested, P is a principal amount invested, I is a interest rate, and T is a number of years. Okay, then annuity, that future value of present money also can be done with the help of annuity. A stream of payments are returns over a time, and this is a formula for only calculating annuity, that is A is equal to P 1 plus I power of T minus 1 divided by I. A means future value, P is annual investment, I rate of interest, T is a time period. This is nothing but annuity. Now coming to the discounting. Discounting means present value of future money. So in which future sum is discounted back to the present time to find out its current and on the present value. Discounting means the future less now going for on the discounting, and whatever we are going to get in the year discounting and to see what is the current or the present value. Okay, so discounting is a inverse procedure of compounding. A present sum is core value, it is nothing but compounding. Future sum is discounted to know the present value of future amount, and this is a formula for doing the discounting. PW means present worth of future money, and P is a money value in future, R is interest rate, and N is I think instead of N it should come T, otherwise you have to write N, that is a project life period in years. And similarly in discounting also you can calculate present value of annuity or stream of constant annual payment, and this is a formula. And any doubt regarding compounding and discounting? This is very important. If no doubt, then we can move.
Yes, sir. Yes, sir. Okay.
Inspection, payback period, proceeds per unit of outlay, average annual proceeds per unit of outlay. Under discounted measures, which includes benefit cost ratio, net present value, internal rate of returns. Under undiscounted measures, I told you one is a ranking by inspection. Ranking by inspection means it is based on the size of the cost or length of cash flow streams. For example, suppose we have two projects. Same investment and the same value of production, but the only difference is the length of the period. So only the difference is the length of the period, and the project would be prepared longer duration and compared to shorter one. That is by ranking by inspection. Second, payback period. Payback period means it is a length of time it is required to get back your investment from your returns. Okay, that how much time it takes to get back and get back your investment, it is known as the payback period. And payback period can be estimated using this formula: P is equal to I divided by E. P means payback period of the project in years. I means investment of the project in rupees. E is the annual net cash revenue in rupees. Here, suppose there are only two projects, project A and project B. And project A, the payback period is 3.5. And project B, payback period is 5. So you have to select the shorter payback period. So project A is preferred as compared to project on the B. Okay. So payback criteria: shorter the payback period, more desirable the projects. This is the steps for computing payback period. First, you have to compute year-wise total cost, including initial investment. And the second, you have to work out net returns by subtracting total cost from the gross profits. And the third one, you have to compute the cumulative net returns over the years, then identify the year where cumulative net returns turn zero or become just on the positive. And the fourth one, proceeds per unit of outlay. And it is the total net value of incremental production and divided by the total amount of investment is known as proceeds per unit of outlay. The last one is average annual proceeds per unit of outlay. It is obtained by dividing. First, you have to divide total net value of incremental production and divided by the number of years in which it will be realized. Then it is average proceeds. So if you divide total net value of incremental production by the number of years, you will get average on the proceeds. Then further divided by the original outlay for capital, then it is known as average annual proceeds per unit of outlay. But there is a drawbacks, these undiscounted measures. The problem is, for the same data of the project, we get, different ranking, and choice process become useless. Ranking by these methods are inconsistent, incompatible. So the another another drawback with the undiscounted measure, it ignores, time value of money. In case of discounted measure, so we are taken care of, time value of money, and that is why we frequently use, NPV, IRR, and the BC ratio instead of, this payback period and proceeds per unit of outlay, average annual proceeds per unit of outlay. Now coming to discounted measures, and one is a net present value. So net present value means, here we are doing the discounting. I told you what is a discounting and what is the formula, then why we are doing for the discounting. Okay, so I am not going to discuss further. So what is a net present value? So net present value means it is a difference between present worth of benefit stream and present worth of cost stream. It is known as on the net present value. Same I have written that NPV should be found out by subtracting present value of cash outflow from present value of cash inflow. Same I have written down also. And the project should be accepted if NPV is positive, that is more than on the zero. Then we can say that investment made on the project is economically viable. And these are the steps for calculation of NPV, steps in calculation of NPV. The foremost important, okay, while doing, this discounted measure, so you have to choose, appropriate rate of discount. Generally prevailing commercial interest rate is taken as a discounting factors. Second, you have to compute the net benefits by subtracting the yearly total cost from the gross on the benefit. This is a formula for calculating net benefits. Okay. Third, you have to work out the net present worth of net benefits by deflating the net benefits. By deflating net benefits means by doing the discounting. So you have to calculate net present worth of benefits and net present worth of cost. Okay. And this is a formula for calculating NPV method. BT means that is a benefit in each year. R is a rate of interest, and T is a number of years, and INB is the initial investment. Okay. Suppose there is a series of investment. Okay, so in that case, the present value of such cost should be computed and analyzed. For example, I can say protected on the cultivation, and it is so the law protected on the cultivation, and you might have seen in Maharashtra, particularly this Pune and Nasik, the area under protected cultivation is more. Okay, so in case of protected on the cultivation, so initial there will be a huge investment, okay, for erecting the polio structure. Okay, so in between also there will be investment, okay, because that polio structure or nettos, maybe the irrigation system or drip irrigation system should be replaced once in a 5 or 6 years. So in between also investment happening. So in that case, and this is a thumb rule for selecting NPV, that when NPV is positive, that is NPV more than on the zero, then you have to accept the project. If it is less than zero, it means that NPV is negative, then you have to reject the project. When NPV is zero, and then either you can accept or on the reject your own projects. Then second discounted measure, that is a benefit on the cost ratio. Benefit cost ratio, it is also known as profitability index, we can say profitability index. And benefit cost ratio, it's just like NPV. So in NPV we are doing difference, we are doing the difference, but in benefit cost ratio we are doing dividing, we are dividing. So benefit cost ratio is also related to NPV, as it is obtained just by dividing the present worth of the benefit stream with that of the cost on the stream. And this is a formula. BT means benefit in each year. CT means cost in each year. Number of years. R is a rate of interest. A project is viable and worth taking off. The BC ratio is greater than 1. Then the investment of that project can be considered as economically viable. If BC ratio greater than the 1, then the NP of the benefit stream is higher than that of the cost in the stream. And the third one is the internal rate of return. So internal rate of returns means it is a discount rate at which net present value is equal to 0. Same I have written that the rate of return that makes the NPV of all cash flow from a particular investment equal to 0. And the higher a project IRR means higher the IRR, more desirable it is to undertake the project. Assuming all the projects require same amount of upfront investment, the project with the highest IRR would be considered best and undertake the projects. See, this is a formula for calculating IRR. IRR also can be calculated, by using trial and error method. Trial and error method means by using, interpolation method. Okay. In interpolation method, what we are doing, so we are selecting two discount rate. Okay. One is a lower discount rate where NPV become positive. Another NPV negative where, where we are selecting, higher discount rate. So in while calculating IRR, so we are selecting two discount rate, one discount rate lower, another discount rate higher. Lower discount rate that NPV positive, higher discount rate that NPV is negative. And this is a formula for calculating trial and error method for calculating IRR. That is a lower discount rate plus difference between two discount rate and multiplied by NPV at a lower discount rate and divided by sum of two discount rate NPV. So you have to ignore the sign. And the project should be selected if IRR more than the cost of capital, then the project, then investment made on the project is treated as a economically viable. If it is less than K, then you have to reject the project. And up to this, any doubt? Hello?
Yes, sir. Yes. Sir, my question is that what kind of multiple choice question will be asked on this undiscounted and discounted measure?
See, multiple choice means sometimes they may ask, I told you that like sometimes they give, like NPV, IRR, PC ratio, then payback period, and which one is not discounted measures or which one is not undiscounted measures. Okay.
Okay.
So that type of question they can ask. Second, that criteria they may ask. Criteria in the sense, like I told you now that it should be, like more than 0. Okay. And in case of BC ratio should be more than 1. And internal rate of return should be the more than the cost of capital. Okay. So that type of question they may ask. Sometimes they may ask definition also. Okay. They may give, a definition and you have to select whether it is a BC ratio, IRR, or internal rate of returns. Okay.
Yes,
And
sir.
do
Yes,
you have old year question papers?
No. So we don't have any question paper. Means last year we have just dictated some questions. Likewise, we didn't get the as it is question paper from internet.
Okay, let me check. If it is there, I will share with you. Okay.
Yes, sir. Yes, sir. Sure. Thank you so much, sir. Yes, it will
I
be
will
very
check.
useful for us, sir.
I have, I think that the years means also I have a question paper, sir. So I will check it. If it is there, I will share with you. Otherwise, I will share with Sanjay, sir. You can get it from him.
Yes, sir.
Then
Yes. Please share.
yes, I would suggest you better go through some, like this one, what to say, like in IRI also, earlier they used to conduct, for PhD entrance. Okay. So there they have given this multiple choice question. So for your guidance or maybe for your reference, that also you can go through it. What type of questions and how
SRF
they are
question
asking.
paper, sir.
SRF question paper also you can see. Okay.
Yes, sir. Yes, sir. Thank you, sir.
Sometimes what happens for in ARS net, they won't ask difficult. They will not ask difficult questions. Sometimes they cover Subba Reddy, that VT Raju, then Acharya marketing. Okay, only the basic they may cover. Sometimes they cover the difficult part that we cannot predict. But what I would suggest that you should be clear that basic one. Once basic one is knows, then you can click the difficult question also. You should understand the basic concept, that is more than sufficient. Then you can start reading for the difficult one. Okay.
Yes, sir. Yes, sir. Thank you, sir.
Then we have this modified NPV and modified IRR also. See, in case of traditional NPV, it is based on assumption that whatever that cash flow we are getting, so we are reinvested at the rate of returns equal to the cost of the capital. See, when we are doing NPV, the traditional NPV, we are assuming we are taking the discount rate. We are taking the discount rate, or we are taking the cost of capital, which is prevailing in the market. Okay, or maybe which is prevailing in the bank. Okay, sometimes what happens, suppose I have 1,000 rupees. Suppose I have 1,000 rupees. If I deposit with the banks, I may get at the rate of interest maybe 12. Okay, let's say 12%. Okay, suppose the same amount, if I give or if I lend to someone not in the bank, maybe to the friends or maybe the money lenders, I may get instead of 12%, I may get 13 also, 13% also, I may get 14% also. So in that case, you should not apply NPV, you should go for modified NPV. So when this assumption is not valid, the reinvestment rates applicable to the intermediate cash flow need to be defined for calculating modified NPV. And this is a formula for calculating modified NPV. R is the reinvestment rate, and K is the cost of capital, CT is the net cash outflow at the time of T. Then modified internal rate of returns. This is alternative to IRR. There are many problems in IRR. So to overcome this and modified internal rate of returns has come. The main problem with the IRR, see, in modified IRR, we assume that project cash flow are reinvested at the cost of capital. Whereas the regular IRR assume that the project cash flows are reinvested at the project own IRR. So the modified IRR is more realistic than the regular IRR. That is one difference. Second, the problem of multiple rates of IRR does not exist with the modified IRR, which is very common in agriculture. Third difference, IRR method cannot be applied in case where during investment use, except for initial investment, the negative net cash flows appeared. I told you better example or best example is protected on the cultivation. In protected cultivation, not only initial investment, okay, for erecting polyhouse, in between also you are spending so much of investment because you have to replace, drip irrigation system. You need to replace, nettos. You need to replace polythene sheet and so on. So in between also you are making so much of investment. Sometimes it comes negative net returns. So in that case you cannot apply IRR. If it is coming in between also negative net cash flow, then it will become a multiple IRR. So to overcome this, so we have to apply modified IRR. And this is a formula for calculating modified IRR. Then this is very important, appropriate selection of choice indicators. See, in discounted measure, I told you, and you have to be very careful, for selecting, you have to select, appropriate on the discount rate. Okay. Then ranking of acceptable alternative project is not possible with NPV because NPV or NPW both are same. Is absolute measure, it is not on the relative. So BC ratio and the internal rate of return is a relative measure. but NPV is the absolute measure. And this is very important. EC ratio is mostly used to evaluate social project, but not on the private on the projects. But in general, IRR is most commonly used. The advantages of the advantage or the merits of IRR, it is an unambiguous estimate, and it is a consistent, and it got wider on the applicability, and it is a unique, and it takes care of time value of money. But the limitation of IRR, that I told you that IRR we are taking two discount rate, okay. So that precise IRR, that means accurate IRR is obtained with a narrow difference in the two discount rates assumed. Then complications are involved in the computation of IRR. It is a tedious on the process. And this is the merits and on the demerits of IRR. Then another one is a sensitivity analysis. This is also there in your syllabus. It is very important. Sensitivity analysis. See, whatever we have seen now, that is the data used in the project evaluation remain unchanged over a period of time. Okay, but in reality, this is not happening. Okay, because the price of agriculture produce. Okay, let's say our commodity or rice or wheat. Okay, then the input which we are using for agriculture production purpose, okay, like seed, fertilizer, pesticides, and so on, that is also keep on changing every year. It is not on the same. So under this condition, our estimates of economic analysis will be misleading. Hence, there is a need for considering the probable changes in the data required for the project appraisals. And it is also sometimes necessary to know that how far our estimates of project appraisal remain constant under changing situation of cost, price, and yield. So in that case, we have to use sensitivity analysis. See, sensitivity analysis, of the project appraisal include the following points: that you have to see the first length of the period and over the existing one. Second, I told you, see, there is a changes in price, changes in yield, and changes in inputs. Okay, suppose there is a change. Suppose if it is increasing or if it is decreasing, the price of goods or services. Okay, then what will be the changes? Like what this is like assumption only, like assumption, like if 10% increase in price of goods, and what would be the result? Okay, if it is increased 20%, 30%, what would be the changes? Okay, similarly, changes in the level of cost, like per inputs. Okay, like if you increase 10%, if you decrease 10%, 20%, 30%, and what would be the changes? And the changes in the yield also, like crops, let's say crops or livestock, then what would be the changes? Okay, see, in sensitivity analysis, up to some extent, we are predicting the risk and uncertainty. But elaborate risk analysis, using probability analysis or stimulation model employing through randomization, are the most appropriate tools to indicate the real worth of the project under condition of risk and uncertainty. So in order to predict more accurately the risk and uncertainty, so we have to use probability analysis or stimulation model for estimating risk and uncertainty. Now coming to the financial statements. See, in financial statements, there are 4 types. Okay, this is also there in your syllabus. Okay, I have seen. Okay, one is a statement of source, use of funds from lender or investors. Okay, then pro forma projected statements, actual performance statement, and financial statement on the analysis. Okay, see, in projected statements means it is used for protecting the future profitability of the business. Basically, there are only 3 types. One is a cash flow statement, another one is a 3 years income projection, and break even on the analysis. So cash flow statement, see, you have to remember here, cash flow statement means cash inflow and cash outflow. 2 component is very important in case of cash flow statement. So cash inflow means that a business, a company pay for the ongoing activities or external investment. One. Second, all cash outflow means that company pay for the activities and investment during that period. So that is known as on the cash flow statements. So cash flow statement deals only with the actual cash transaction and not with the depreciation and amortization. This is very important. In cash flow statement, we are not taking care of depreciation and amortization. So there is a difference between depreciation and amortization. In depreciation, when you have a salvage value at the end of the period, then you can go for depreciation. If you don't have the salvage value, then you have to go for the amortization. Is it clear? What is the difference between depreciation and amortization?
Yes, sir.
See, depreciation means what is the salvage value? Anybody can tell? You might have studied. What is the salvage value? You might have studied production economics. Have you studied straight line method?
Sir, it is junk
Hello?
value,
Yes, okay.
junk or a scrap value of that particular asset.
Okay. So that is known as the depreciation. Okay. Depreciation means if you have a salvage value at the end of the period, okay, then you can go for depreciation. Otherwise, you have to go for amortization. I can say, for example, like a tractor, you take a tractor. Suppose the life of the tractor is maybe 10 years. Okay. Even after 10 years also, if you are selling to someone, some minimum amount you will be getting. So in that case, you have to go for depreciation. Like I told you that drip irrigation, the expected life is 5 years. After 5 years, if you are selling to somebody, nobody will buy that one. Then in that case, you have to go for amortization. So cash flow statement prepared on a monthly basis for the next taxpayer, the business. Okay. And this is a template for a preparation of cash flow statement. Okay. This is for your understanding. I put it here. Okay. Then second one is a 3-year income projection. So it includes only projected income and deductible expenses. At the end of each year, venture can compare the projection against the actual performance. And this is a preparation of 3 years income projection, which includes income and expenses, then on the net profit. Okay. And the third one is a break-even analysis. What is the difference between break-even analysis and break-even point? Can anybody tell? Break-even analysis and break-even point. See, break-even analysis means break-even analysis indicates the level at the level of production, means the level, the cost and the returns are in equilibrium. That is known as break-even analysis. So break-even point means the total cost and the total revenue intersect. This known as break-even on the point. So which indicates the level of production at which producers or a business neither make profit nor on the losses. It is known as the break-even on the point. If business want to make a profit and they should produce, they should produce more than this break-even on the point, where total revenue more than the total cost is nothing but profit. If below the point, below the break-even point, it becomes loss. And the break-even point can be estimated using this formula: fixed cost divided by sale price per unit minus variable cost per unit. Fixed cost means it is like administrative overhead plus on the interest, or the example of fixed on the cost. In fixed cost, it remains same irrespective of the level of the production. And variable cost, it varies. Okay. As irrespective means it varies, with the volume of production. If volume of production increases, your variable cost also it increases. For example, like cost of goods plus on the cost of goods on the sold. Okay, so that also comes under variable cost. Then sales price per unit means that is assume that is expected sales per unit. Okay. See, break-even point also can be estimated in different ways. One, you can estimate in terms of physical means like physical terms, okay, in quantity. And break-even points also you can estimate in terms of rupees. Okay, and the break-even point you can also estimate in terms of capacity utilization. Okay, and this is nothing but break-even analysis. Then another third type of financial statement is actual performance statements. So actual performance statements, these are the historical financial statements reflecting the past performance of the business, which includes balance sheet. So balance sheet means it is a financial position of the company and during a particular point of time, okay, which includes assets and the liabilities and net worth. Assets means anything it has a value or owned by the company, it is known as on the assets. Liabilities means anything it has a value, it is owned by the others, it is a liabilities. The difference between assets and liabilities, it is known as on the net worth. So the importance of balance sheet, it is used by the investors or creditors, other stakeholders to understand the financial health of an entity. This is a preparation of balance sheet or template of balance sheet. Assets should be recorded on the left side and the liabilities should be on the right hand side. Okay. And one more thing, just I want to say, in assets itself, we can classify into three types. You might have studied, current assets, working assets, then long-term assets. Current means current assets means so assets can be converted, which is very liquid and it can be converted, quickly as a cash. For example, stock of farm commodities. Okay. Then intermediate assets are on the working assets. So here it takes some time to convert into cash, 2 to 5 years. For example, like poultry or livestock, or maybe poultry or livestock. Okay. Then third, long-term assets. It is a permanent in nature. It takes long time. That is more than 5 years to convert into cash. For example, like farm, building, okay, and land, etc. Then liabilities also we have three types. One is a current liabilities. The debt should be paid within a short period of time, like let's say within a 1 year. Then current, intermediate liabilities means it should be paid. The duration of the repayment should be 2 to 5 years. The long term it should be more than 5 years. Like a short term liabilities, for example, crop loan. Then intermediate liabilities, for example, like like we can say that like maybe the livestock loan, maybe we can say the long term we can say that a tractor orchard loan or example we can say. Then third one is a profit and loss statement. A profit or loss account, so the company revenue and expenses over a particular period of time, either 1 month or on the consecutive month over a period of time. You should clear, you should know. So what is the difference between these three? One is a profit, okay, loss statement. Then second is a balance sheet, and the third one is a cash flow. See, profit and loss statement, okay, is prepared to display our revenue and expenses. Be clear, profit loss means only two components included. One is a revenue and the second is a expenses. Okay. And it is used to show that how much the business earned during the year. Even the title itself, it is there. Title itself, you can understand that how much a company or a business earns during the year, that is known as profit and on the loss on the statement. If revenue more than the expenses, then there will be profit, otherwise it will be loss. Another important things in profit and loss, assets, liabilities, and owner's equity are not included in case of profit and loss statements. Okay, this is about profit and loss statement. Second, balance sheet. So balance sheet is prepared to display our assets, liabilities, and owners on the equity. It is used to show that how much a business is worth. It is very important how much a business is worth. So the difference between assets and liabilities is known as owner's equity. Then third one, cash flow statement. So cash flow statement, two things is very important. One is a cash inflow and a cash outflow. And basically, it shows the changes in a business bank balance. Okay. Suppose if all cash inflow exceed cash outflow, then we can say that it is a positive cash inflow. Opposite, it is a negative cash inflow. That one more thing you have to keep in mind, that cash flow is different from the profit and loss statement, because it only relates to cash transaction. Things like depreciation, credit, sales are not included. You have to keep in mind. So cash flow statement, cash flow and profit and loss statement, it differs only the cash transaction. In cash flow statement, it does not include on the depreciation. Is it clear? These three. This is very
Yes, sir.
important. Yeah. Profit and loss, balance sheet and cash flow. Now for coming to financial statement analysis, okay, and there are different types, okay, and you might have studied, okay, one is a liquidity analysis, and the liquidity of the business is ability it has to meet the financial obligation, okay. A liquidity ratio can be used to see if the business is in any risk of insolvency, and the liquidity can be estimated using this formula. One is a net working capital, is difference between current assets and current liabilities. Current ratio means current assets divided by current liabilities. Quick ratio means current assets inventory by current on the liabilities. Okay. So higher the ratio means more risk of business. Okay. No. It's not like that. So here, if that networking capital means here means that what I can say. Quick ratio. Normally for current ratio, 2 is recommended for the business. Okay, quick ratio that is more than 1.5 or greater is recommended. Then in case of profitability analysis, we'll measure the ability of the business to make a profit, and profitability analysis can be estimated by using this formula. One is a gross profit margin. Gross profit margin means gross profit divided by sales. Operating profit margin means income from operating sales divided by sales. Net profit margin means net profit divided by sales. So higher the margin, higher will be the profit. So profit will be more for the business. And third, debt measures. Debt position of the business indicate the amount of other people money being used to generate the profit. So more indebtedness of the venture, greater will be the risk of failure. One is a debt to asset ratio. And this is very important. See, somebody is asking that what kind of question they may ask. So this kind of question also they are asking. Like you have to select the formula in debt to asset ratio, and they will give 4 formula, and you have to select the correct one. So debt to asset ratio formula is total asset divided by total liability divided by total assets, and debt to equity ratio means total liabilities divided by 1 on the equity. So here, if ratio is more, then more risk will be the business. Now another one is investment measures, which indicates the ability of the business to get the returns. So there are only several methods to estimate investment measure. The most commonly used method is the return on investment, and which is estimated by dividing, net profits divided by total on the assets. Up to this, is there any doubt? See, so far I have covered agriculture projects. So I have covered this compounding and discounting. Okay. So now I'm going to cover about this KCC e-banking, and the third one is e-banking, and the third one is financial inclusion, and this is very important. See, in India, so there are 2 main source of credit for agriculture sectors. One is institutional sources, another one is a non-institutional sources. Okay. So institutional sources means which includes commercial banks, regional rural banks, and the cooperative banks. Okay. Then non-institutional sources means which includes relatives. Okay, borrowing from relatives and friends and money lenders. Okay. To improve credit flow to the agriculture sectors and to minimize the role of non-institutional sources, and the government of India have taken several steps from time to time, like one is a social control of banks. Okay, was came in 1968. Okay, then nationalization of banks. Okay, 1969 and 1980. Then introduction of lead bank schemes 1969. Then formation of regional rural banks 1975. Establishment of NABARD 1982. Introduction of self-service area concept 1989. Then financial sector reforms 1991. Then launch of concept of microfinance. Then it came microfinance. Then scheme of linkage of SHG with the banks 1992. Then creation of Rural Infrastructure Development Fund 1995 and 96 with the NABARD. Then Kishan Credit Card Scheme came in 1998 and 1999 with the objective of to provide sufficient credit to farmers for cultivation for production on the purpose. That was the purpose Kishan Credit Card Scheme. So the Reserve Bank of India has set up one-man high-level committee of R.V. Gupta in December 1997. The committee submitted its report in April 1998. Then based on the recommendation of above committee, that is R.V. Gupta committee, and NABARD introduced KCC in August 1998. And RBI directed to all scheduled commercial banks and NABARD directed to all regional rural banks and the cooperative banks. The objective of KCC to meet the short-term credit requirements, okay, for cultivation practices, okay. Then post-harvest expenses, okay. Then marketing loan, consumption loan, and to meet the needs of working capital and to meet the investment on the credit. See, sometimes they may ask because you have to be very clear, okay. KCC, which includes consumption loan also. Okay, you have to see this all objectives, okay. Then working capital means it includes farm assets, even now they have added for capital required for floriculture, then for protected cultivation also they started giving working capital. Then investment credit like pump sets, sprayer, all comes under investment on the credit. And these are the silent feature of the KCC scheme. See, the objective was to provide adequate and timely credit for the comprehensive credit requirement of farmers under single window with the flexible and simplified on the procedures. Okay. The eligibility, who are eligible for KCC, all the farmers, okay, individual, it can be joint borrowers, who are owners of cultivators and tenant farmers also eligible to get on the KCC. And maximum age limit at an entry point for individual is 70 years. And the validity, this is the advantage of KCC. See, there are two type of loan for farmers. One is a KCC, another one is a crop loan. And a crop loan that every year you have to submit the documents and you have to get the loan. The advantage with the KCC, it is valid for 5 years, only subject to annual review. Once you have submitted the documents, it is valid for only 5 years. Only the adangal you have to submit every year. Adangal means what type of crops you are growing, you are on the field. Kind of crops growing, you are on the field. That you have to submit only every year. So keep in mind that KCC is valid for only 5 years. Then regarding security, as per the guidelines, there is no collateral security required up to a loan limit of 1 lakh. And the collateral security may be obtained for loan limit above 1 lakh. Okay. And up to only 3 lakhs, okay. Then fixation of credit limit, short-term credit limit, the scale of finance. See, I told you that see, the scale of finance is fixed by that is a state level technical committee and a district level of the cooperative technical committee, okay. And based on your cropping pattern, okay, that we will discuss in later, okay. And see, for in case of for scale of finance for the crop loan or crop X of area cultivated plus 10% limit towards consumption requirement plus 20% limit towards working on the credit and the expenses. Okay. For second and subsequent years, first year limit for crop cultivation purpose arrived as above plus 10% limit towards cost exclusion. Okay. Then for margin farmers, and this is a limit, okay, flexible limit, okay. I told you that is valid for only 5 years. Then margin money, see up to 1 lakh. If you are getting up to 1 lakh and there is no margin money, for above 1 lakh and applicable margin will be 15 to 20%. Margin money means you have to put from your pocket. Suppose 100%, suppose you are requesting 1 lakh, suppose you are requesting 3 lakhs. Out of 3 lakhs from your pocket, you should put your contribution 15 to 20% and the remaining 75% will be given by the bank. That is a margin money. No due certificate. There is no need for getting no due certificate from other banks for agricultural loan up to 50,000. If it is goes more than 50,000, then you have to get no due certificate from regional rural banks, cooperative banks, maybe commercial banks. Okay. Then rate of interest up to 3 lakh 7% per annum, where interest subvention is available. Otherwise, non-rate of interest applicable. And above 3 lakhs, interest rate applicable for direct on the agriculture loans. Okay. See that 7% per annum. Okay, that is first year. Okay. Once the repayment is done at the right time, okay, without any delay, in next year, that is in second year, NABARD will give subvention of 3%. Okay. In second year onwards, you have to pay only 4% per annum and 3% as a subsidy. Okay. And the repayment period, short-term loan will be normally repayable within a 12 month. Okay. Term loan will be normally repayable within a period of 5 years and depending on the type of activity or investment which you are going to take. Nature of credit. Okay, then the documents to be obtained. These are the documents is required for getting KCC loan. Oh, you have to fill the application form. Okay, then revenue records. Okay, no due certificate, loan cum hypothecation agreement, crop or livestock plant equipments, letter of guarantee or wherever applicable, and mortgage deed wherever is applicable, and other features. Okay, and I told you that in KCC it not only includes consumption also. In KCC, which includes your personal accidental insurance on the scheme also. Personal accident insurance scheme that is attached with the KCC, so which covers risk of KCC holders against accidental death or permanent disability up to a maximum amount of 50,000 and 25,000 respectively, resulting from accidents. Insurance premium payable on personal accident insurance coverage KCC holders will be 15 rupees for 1 year policy and 75 rupees for 5 years. The premium payable to the insurance company shared between the KCC issuing bank and the KCC holder in the ratio 2:1. The difference between a crop loan and the KCC, I told you that the difference is the approach would be multi-product or multi-agents approach in case of crop loan system. KCC multi-credit on the product on the approach. Under on the crop loan, there is no sublimit, and KCC 3 sublimit. One is like production, asset maintenance, and on the consumption and the credit. The nature of credit, okay, no revolving cash credit facility. That is loan granted on a crop receipt basis against execution of fresh document. Here revolving cash credit on the facilities. So I told you that in crop loan, that every year you have to submit the documents in order to get the loan. But in case of KCC, once this document is submitted, it is valid for another 5 years. Then withdrawal limit, in case of crop loan, you will be getting both, either cash and on the kind also you will be getting. Kind means in terms of fertilizers. Okay. Then KCC only cash you are only getting. And this is the main difference crop loan and on the KCC. These are the implementing aspects of KCC scheme. So introduction of KCC scheme. So state cooperative banks was the first to launch the KCC scheme. And based on the model scheme circulated by NABARD in August 1988, then followed by cooperative banks or followed by regional rural banks, then on the commercial banks. Regional rural banks had launched the scheme with the effect from year 1999, had formulated their guidelines on the basis of model scheme circulated by NABARD in August 1998. Commercial banks had launched the scheme based on the model scheme circulated by RBI in August 1998. The eligibility norms, okay, in case of PACS. PACS means that is a primary agricultural cooperative society. All the members with operational holding who were not defaulters were eligible for using KCC. In case of RBB and the commercial banks, KCC issued to only those farmers who were having good track record of 2 to 3 years. Credit limit, this I told you, okay. Okay, fixation of credit limit, I told you. This is very important. This is very important. Credit limit under KCC may be fixed on the basis of operational landholding, cropping pattern, and scale of finance, recommended by district level technical committee and state level of the technical of the committee. Wherever district level technical committee or state level technical committee have not recommended scale of finance or lower scales, then the required amount for crops, banks were allowed to fix appropriate scale of finance depending upon the crop. Maximum limit, okay. In cooperative banks, you can borrow maximum 35,000 to 50,000. In regional rural banks, 50,000 to 1 lakh. In the commercial banks, there is a liberal. You can borrow, 3 lakhs also, 5 lakhs also. And is it clear up to this? KCC? Do you have any doubt?
No, sir,
KCC?
no doubt.
Okay. Now coming to the financial inclusion. See, financial inclusion now, let me tell you why financial inclusion has come. Okay. See, at present, in India, okay, about, 50% of the farmers, okay, who are financially excluded from the formal or informal on the sources. In order to bring these people into mainstream, okay, to avail this financial service. So the concept of financial inclusion came in 2010. And this is beyond for this is a concept why it came financial inclusion. In financial inclusion, basically there are only two pillars. Okay, one is a financial inclusion. Financial inclusion, it is about supply side aspects. Okay, financial inclusion, it is about supply side aspects, about providing the financial services. Okay, then second is a financial literacy. It is about demand side, by providing demand side aspects, by providing by creating awareness about the financial product on the services. Then what is a financial inclusion? So financial inclusion means it is a process of ensuring access to financial services, timely and adequate credit needed by vulnerable groups such as weaker section, low income groups at an affordable on the cost is known as financial inclusion. And this is very important. The Committee on Financial Inclusion, chairman was Dr. C. Rangarajan. And financial inclusion came in 2010. So this then components of financial inclusion, so which includes bank accounts, okay, financial literacy, remittance. Remittance means money transfer facilities, then credit of products like KCC, GCC, etc. Then insurance, pension, and capital market on the participation. So these are the components which included in financial inclusion. And objectives: one is a economic mobilization of saving, financial system, social sustainability, and the institutional aspects. Okay. Now, why financial inclusion? So I have written, and you can go through it. Okay. Terms saving into to make saving into investment. Okay. Then to protect family against unforeseen circumstance. Okay. Child the future secured. Okay. Then government subsidies. So now whatever it may be, and everything like DBT, direct benefit on the transfer. For that you need accounts. Okay. If there are no formal channel to save the money, then low income household are more likely to fall victim. Okay. If everyone has bank account, lower the transaction and paperwork at time, economic well-being of the poor people also ensure on the social and the our money. Okay. So then there are several initiatives taken by the government. Okay. In a financial inclusion scheme in India. One is a Pradhan Mantri Jan Dhan Yojana. Then Atal Pension Yojana. Then Pradhan Mantri Vaya Vandana Yojana. Then Stand Up India Scheme. Pradhan Mantri Mudra Yojana. Pradhan Mantri Suraska Bima Yojana. Suganya Samriddhi Yojana. That is mainly for girl child. Okay. Then Jeevan Suraska Bandhan Yojana. Then Credit Enhancement Guarantee Scheme for Scheduled Caste and Scheduled Caste. The Venture Capital Fund for Scheduled Caste under the social sector initiatives. Then Varshida Pension Bima Yojana. These are the initiatives taken by the government to achieve financial inclusion. Then one more thing I forgot to include, that is electronic bank. Sorry, that is e-banking. E-banking means it is nothing but electronic banking. It is also known as electronic. It is also known as electronic fund transfer. So electronic fund transfer, is nothing but the use of computers, okay, and the telecommunication to enable banking on the transaction. That is done by telephone or on the computer, okay, rather than human interaction, rather than by human. The main feature which includes the electronic fund transfers, like retail purchase, then ATM also, which includes e-banking, that is automatic teller machines, then automatic payroll deposit or bill payments, okay, are included in electronic banking. And there are various forms of electronic banking, and you might be knowing like what we are using that every day. So all comes under that e-banking. Like internet banking we are using, that is also e-banking, okay. Then ATM we are using, that is also e-banking, that is automated teller machine. Then telebanking. Then what we are using, smart card, what we are using, smart card, debit card, credit card, e-check, everything comes under the that is comes under e-banking. There are other forms also in e-banking, like we do direct deposits, okay, then telephone, then electronic bill payment, then electronic check conversation. So all comes under that electronic banking. And that's all about my presentation, and with this we can let us discuss if you have any questions or clarifications, okay. So okay, so I request all of you kindly switch on your videos. Hello, so there are 15 participants, okay. So I request participants kindly switch on your videos. So what about others? Savita, Vishaka, Supriya, Dr. Rachna, Dr. Baswaraj.
Hello, sir.
Only, yes, sir. Only there are only 13 participants. What about others?
Sir, I have one queries. Can I ask
Yes,
you?
yes, yes.
If you permit? Sir, I first of all look to congratulate you, sir, for delivering very nice presentation about this agricultural project evaluation and other kind of the thing that is related with that. Sir, many times if you see, I'm just curious to ask that particular thing from the practical point of view. If you
Okay.
see in terms of the agricultural project evaluation,
Okay.
many times we came across the choice of about the discount rate.
Yes.
Yeah, because as it is not any standardized procedure or the criteria to select the good discount rate. But if you see the many literature or what we suggest as per the Gattinger book, that is ideal discount rate should be 12%. Yes.
Yes.
And so my point is that in your opinion or as per your expertise or as per your exposure, so what should be the ideal discount rate for the agricultural project evaluation when we talk about the agriculture project?
See, in agriculture project, I told you. So for that, you have to select appropriate on the discount rate. So this appropriate discount rate should be selected based on the current market interest rate. So normally you should take 12% is the best. Even if you go to bank, if you take a term loan, you forget about the short term loan. Short term loan, the rate of interest would be 12%. But if you are taking term loans, okay, so the rate of interest would be 12%. So the appropriate rate of interest you have to take on the 12% for calculating these agriculture projects.
So means more than 12%, right?
Yes, 12%. 12, 13 or 14%, but it should be 12%. Because
Okay, sir.
because you have to see the bank side also. Even if you are taking a loan from bank, term loan, they used to charge 12%, and the same we are taking into consideration.
Okay, fine, sir.
So what about others? No doubt, no questions.
Hello, sir.
Yes,
Sir, uh, please explain about KCC.
please.
KCC, Kisan Credit
Ah,
Card.
yes.
What is meant by interest subvention, and if a farmer is unable to pay the short-term loan, then what would be the interest rate?
Yes. So that is very good question. See, in KCC, the advantage is, I told you it is valid for 5 years. Okay. That initial year, the rate of interest is 7%. Okay. Second year onwards, and farmers, you are supposed to pay only 4%, and 3% is borne by the NABARD. Okay. NABARD gives us a subvention. Okay. Suppose farmers are not paying within that stipulated time, then in that case, instead of 7%, then farmers has to pay 9%. So the rate of interest would be 9%. Is it clear?
Okay,
If they
sir.
are not paying on right time, and the farmers has to pay additional 2%. Okay, so 9% they are supposed to pay rate of interest.
And sir, what about KCC given for means जो animals rear कर रहे हैं उनको भी अभी KCC दिया जा रहा है ना, तो उसके बारे में?
Yes, yes. Now they started, giving for for allied sectors also, for allied activities also they started giving, because they have included consumption also. Earlier it was not there. Okay, so now they have included consumption also. For marketing of your product also, they are giving a loan.
Okay, sir.
That
Thank
you have
you.
to be very careful. Okay.
Okay, okay,
Sometimes it may come in multiple choice questions. Okay.
okay, okay, sir.
And what about others? See, I have referred, the books. Let me show you. So I have referred these books. Could you able to see? So agriculture finance and management. This is very good book. So the author is Subba Reddy P. Raghuram. And please you go through it, and if you don't have, and better to buy it. Okay. So there is one unit for agriculture ARS or JSRF for mains, that is agriculture finance and the project management. You don't read anywhere, don't refer other books. You better to read this only one books, that is more than sufficient for unit 4. The only things you have to refer outside means that additional information, I would say, like I told you, like this KCC. Okay, maybe here also maybe given, maybe that is not updated one. For that you have to check maybe Google, or you maybe check some reports. Okay, that additional information you have to check it, in websites. Even like financial inclusion. Okay, maybe KCC. Maybe they might have given book the target and how much they kept target for every year, and how much we have achieved. What is the percentage of share of institutional, non-institutional? That you have to check in on the report. That recent update that you should only keep in. You should keep on updating. Sometimes they may ask, when I wrote, ARS, this prelims and ARS mains, so they asked me, the Nobel Prize for economics. Okay. So like that, you have to keep in update that kind of information. Okay, if no more question, can we wind up?
Yeah. Thank you so much, sir.
Okay,
Thank you
okay.
so
But
much for
you
this
told
valuable
you
session.
told 30 people, around 30 people, but as of now only 13 people are there.
Yeah, sir.
Huh? No, you
Yeah,
told
actually, they
30,
are only
na?
now today's session, sir.
Hello?
Yes, sir. Yes, sir.
No, your voice is not
But due to
clear.
some connection or negative, yes, sir.
See, I am putting so much
Yeah,
of
yeah.
effort and I am taking
There were
class.
30,
Then
sir.
everybody
But
everybody should attend, na?
yeah, due to some connectivity issues, sir.
Okay, but anyhow,
Yes, sir.
anyhow, you kindly whatever I told you, the books kindly refer and read well. Okay, my best of luck. Okay, and all the best. Okay, to each one of you. Okay, see you. Huh? If no
Thank you
more
so much, sir.
question,
Thank you so much.
if no more
Thank you,
question,
sir.
I'm okay. Okay, I'm
Sir,
ending the
please,
session. Huh?
please share your email ID, sir. Please share your
Yes,
email ID.
yes,
Email
yes.
ID, sir.
I'm putting in a chat box.
If possible, sir, please share your contact number also. If we have
Yes,
any
of course.
difficulty,
Of course,
we will
of course.
contact.
Of course,
Okay,
if
thank you,
any
sir.
doubt is there, please let me know. Huh?
Yes, sir. Yes, sir.
And if you are finding any difficult, the kind of books need to be referred, okay, or what kind of questions they may ask, okay, okay, then you can ask me. So, because since I wrote PRS Net prelims, mains, okay, so I have some idea, okay. I can, whatever I know, I can share with you. It may be helpful for you, okay. And you
Yes,
send
sir.
me email also if any doubt is there. And the meantime, I will see if any question is there, okay, or maybe objective type, maybe subjective type, okay. I can share with you, okay.
Yes.
Okay, then see you, huh? Thank you so much, huh, for listening,
Yes, sir.
my lectures, okay.
Yeah,
Okay.
thank you so much, sir.
Thank you.